Welcome to the Deep Dive, your go-to source for cutting through the noise of earnings season and getting to the clearest insights. Today we're taking a deep dive into the latest financial update from Lucky Strike Entertainment Corp., a name you might recognize as the former Bolero. This is for their fiscal fourth quarter, which ended back on June 29, 2025. This company is clearly in the midst of some, well, truly ambitious transformations. And their recent earnings call gave us a mountain of information to sift through.
Absolutely. And this wasn't just another earnings call. I mean, it presented a fascinating duality. We saw a solid revenue beat, yet it was accompanied by a pretty significant earnings per share miss. All of this was framed within an incredibly ambitious long-term strategic vision. It truly underscores why you just can't glance at the headline numbers. You have to dig into the full context to understand a company's true trajectory.
Right, that tension between growth and immediate profitability is precisely what makes this call so compelling. So for you, our listener, we're going to dissect the key figures, unravel management's strategic vision, and explore what this all means for Lucky Strike's future in the rapidly evolving world of location-based entertainment. Let's start by quickly putting those Q4 headline numbers under the microscope. Digging into the details, Lucky Strike reported revenue of $301.2 million for the quarter. That actually beat analyst estimates by about, $6-7 million?
Yeah, around that.
So that's a solid 6.1% year-over-year increase. Adjusted EBITDA also saw an uptick, reaching $88.7 million compared to $83.4 million in the prior year. And operating cash flow really surged, $22.5 million from just $6.7 million last year. So a strong top line at first glance, but the devil's in the details, isn't it?
It absolutely is. What immediately stands out when we look deeper is that despite these seemingly robust top-line improvements, the bottom line painted a very different and frankly concerning picture. GAAP EPS was a substantial negative 52 cents. That missed estimates by 42 cents.
Well, 42 cents.
Yeah. And non-GAAP adjusted EPS was also negative 49 cents, missing by the same amount. The company reported a GAAP net loss of negative $74.7 million. That's an increase from negative $62.2 million last year. So this highlights a significant disconnect between their revenue growth and, their ability to translate that into profit right now. And adding to that pressure, same-store revenue continued to be a challenge. It declined 4.1% year over year, though it did show some sequential strengthening each month in the quarter and into July.
Okay, so you saw that initial pre-market bump, but as the call progressed and these crucial details emerged, sentiment definitely shifted. The stock closed down 1.5% for the day on higher than average volume, signaling that caution started to creep in once the full picture was absorbed. And that full picture, particularly management's ambitious strategic transformation, is where the real story unfolds. Beyond the numbers, the most significant shift articulated by management was their ambitious strategic transformation. It's a narrative that truly caught my attention. CEO Thomas Shannon laid out a long-term vision to evolve into a, quote, mini Disney in location-based entertainment.
Mini Disney.
Yeah, his aim is a portfolio mix of 40% bowling, 40% water parks, and 20% FECs, that's family entertainment centers, by revenue within the next 5-10 years. He even drew direct parallels to Disney's recent focus on theme parks as their media business evolves.
Interesting comparison.
And this isn't just talk. They've been on an aggressive acquisition spree to make this happen. In early July, Lucky Strike acquired the real estate underlying 58 of its existing locations for $306 million. This move, according to CFO Bobby Levin, is immediately accretive to earnings and cash flow, designed to stabilize occupancy costs and give them capital structure flexibility.
Makes sense. Control the real estate.
Exactly. Then, in late July, they announced the acquisition of 2 significant water parks, Raging Waters Los Angeles and Wet n Wild Emerald Point, along with 3 family entertainment centers, Castle Park, Boomers Vista, and Boomers Palm Springs. These new assets are huge, adding over 1.5 million annual guests to their portfolio.
Wow. Okay, this aggressive expansion immediately raises an important question. How will these acquisitions truly impact their future financial performance? For fiscal year 2026, Lucky Strike is projecting total revenue of $1.26 to $1.31 billion. That's 5.9% growth. And adjusted EBITDA between $375 and $415 million. But what's crucial for anyone modeling out their year is that management clarified something important. These newly acquired assets, while eventually expected to reach company-wide margins within, say, 12, 18 months, they will actually run negative for the first 3 fiscal quarters of FY26 before turning positive.
Negative. Okay, that's a significant initial drag.
It really is. That's a key detail. They're also planning a substantial increase in marketing spend by $10–15 million to get closer to industry benchmarks from under 1% of revenue to around 2.5%. And that will flow into location operating costs. Non-acquisition capital expenditures, or CapEx, are expected to be around $130 million. That's actually down from the previous year, reflecting maybe a focus on high ROI initiatives.
Negative for 3 quarters. Yeah, that's a significant initial hit to profitability. How does management expect to bridge that gap in investor perception, or even internally, while they're integrating such a diverse portfolio? What's the biggest risk there, in your view?
Well, that's the core challenge, isn't it? I mean, the risk is managing expectations and demonstrating tangible progress quickly, integrating large, complex assets like water parks. They have completely different operational requirements, staffing needs, seasonality compared to bowling alleys. It isn't trivial.
Not at all.
It takes time, capital, and skilled management. The playbook they've honed for bowling, focusing on physical asset improvement, enhanced F&B, optimized pricing, increased marketing it needs to prove its adaptability across these very different entertainment verticals. This initial period of negative contribution from the acquisitions is really a test of their ability to execute that playbook and convince the market that the long-term vision is worth the short-term pain.
That's a very clear picture of how these new acquisitions are expected to impact the top and bottom line, especially with that initial drag. But a company can't just buy its way to sustainable growth. What were they saying about their organic growth engines, the innovations driving revenue from within their existing operations?
Right, that's the crucial counterbalance to the acquisition strategy. While the big headlines are the new assets, the underlying health of the existing business determines their foundational strength. And here we saw a bit of a mixed bag. The summer season pass program was a definite standout. It generated $13.4 million in pass revenue from bowling sites, and an additional $4.2 million from parks and FECs.
Pretty good.
Yeah, membership jumped significantly to over 260,000 from 190,000 last year. Management highlighted its critical role in driving repeat visits and upsell opportunities, which is, a powerful way to build customer loyalty.
Yep.
Then there's their strong focus on food and beverage attachment. Food revenue actually saw positive 2.5% same-store comps. While alcohol comps were down 2.7%, they did show improvement. The real win here, though, was non-alcoholic innovation, particularly new craft lemonades.
Oh, yeah?
Yeah. They sold 135,000 units in just 2 months, generating nearly $800,000 in sales. They're on pace for like a $5 million annualized run rate.
Wow.
It shows they're finding success with targeted, high-margin product innovation.
And what about that rebrand from Bolero to Lucky Strike? How's that progressing?
Yeah, the rebranding initiative is accelerating. They have 55 Lucky Strike locations currently in operation, targeting 100 by calendar year end. The Bolero brand is expected to be fully sunset by the end of calendar 2026.
Okay, so a complete phase out.
Right. This is a massive undertaking, and the company expects a lift as more locations transition. They're aiming for a more premium, broad appeal with the Lucky Strike brand. But connecting this back to the broader picture, that same-store sales decline of 4.1% was definitely a concern. Management attributed $6 million of this decline to California, which accounts for about 20% of total sales. However, they saw sequential strengthening each month and into July. July actually turned solidly positive, apparently. And New York was even comping positive.
Okay, so some positive signs there.
Yeah, it suggests their increased marketing efforts and targeted strategies are starting to gain traction, especially as they anticipate easier comps starting in September. That could significantly aid their recovery in that metric.
Okay, and on the capital front, what's their game plan for funding all this expansion and transformation? Seems like a lot of capital needed.
Well, CFO Bobby Levin noted strong liquidity at $342 million, with $60 million in cash. Net debt stood at $1.3 billion, with a bank credit facility net leverage ratio of 2.9.
Okay.
They also reaffirmed their capital return strategy. They have $92 million remaining under their share buyback program and declared a quarterly dividend of $0.055 per share. One detail that might have caught some eyes was the filing of a shelf S-3 registration.
What's that about?
It was described as basically housekeeping for liquidity optionality. Essentially, it's a pre-filing that allows them to quickly issue securities like debt later on. It gives them flexibility to access unsecured debt markets, maybe to refinance a bridge loan used for the property acquisition, and just maintain overall financial flexibility for future growth.
Okay, so pulling this all together, what does this mean for you, the investor, looking at Lucky Strike Entertainment?
Yeah.
This company is clearly undergoing a huge strategic shift, aiming to become this diversified, location-based entertainment powerhouse. It's a bold play that certainly warrants attention.
What's truly fascinating here is the long-term vision, that CEO comparison to Disney.
Yeah, the mini Disney thing.
Right, particularly their pivot into theme parks as their media business wanes. It's a bold comparison. It highlights the immense revenue potential of these, quote, irreplaceable assets. Raging Waters Los Angeles, for instance, generated $24 million last year alone. Compare that to an average bowling unit's $3.4 million.
It's a big difference.
Huge difference. This stark difference in revenue potential per asset is clearly the engine behind their mini Disney vision. But, this also begs a critical question. How will Lucky Strike manage this significantly higher capital intensity, far more complex operations, and the extreme seasonality that come with these larger, fewer assets compared to their bowling-centric past? It's a different beast entirely.
And that's precisely why the market's initial reaction, despite the revenue beat, signals caution around profitability. The wide EPS miss and the fact that these new acquisitions will be dilutive for several quarters. It means execution on their playbook and cost discipline will be absolutely critical.
Absolutely.
The increased marketing spend needs to translate directly into sustained organic growth, especially in challenging markets like California, where they acknowledge they've seen some softness, they're making huge bets, and the market wants to see those bets pay off sooner rather than later.
Exactly. And the rebrand from Bolero to Lucky Strike is also a key lever here. While still early, the company expects a lift as more locations transition. This entire strategy hinges on their ability to consistently improve acquired assets, drive F&B attachment, and convert that season pass engagement into higher retail spend across a much broader and more complex portfolio now. And for anyone modeling out their year, that note about the acquired assets running negative for 3 quarters of FY26.
Yeah, that stood out.
That's a classic example of a detail that can trip up even experienced analysts if they're not listening closely enough. The ability to manage the inherent seasonality of water parks and FECs, which dramatically over-earn in summer, but can run negative for most of the year. That will also be a significant test for management in the coming quarters.
Okay, time for our favorite segment. This is purely for entertainment purposes, definitely not financial advice. But if we were to pitch an outrageous but plausible trade idea based on this call, what might it be?
All right, let's brainstorm here. Imagine this. You go long Lucky Strike Entertainment, not just on the mini Disney vision, but specifically targeting a long straddle.
A long straddle, okay.
Yeah.
Betting on volatility.
Exactly. An option strategy betting on significant price movement in either direction for the late 2026 earnings cycle. But here's the outrageous part. You pair it with a short position in a regional, bowling-only competitor.
Ooh, short a pure play bowling competitor. That's certainly unconventional. Walk us through the deeper thinking there. Hedging against their own legacy business model, in a way, or betting against that specific segment.
Well, the core idea is that Lucky Strike's aggressive diversification into water parks and FECs, coupled with their playbook for improving underinvested assets and the accelerating Lucky Strike rebrand, it gives them multiple growth levers that a single vertical competitor simply lacks. Right now, the market is focused on the EPS miss, fair enough. But by late 2026, the acquired assets are projected to hit company margins, the Bolero rebrand will be complete, and the increased marketing spend will have had a full year to build brand awareness.
So the long straddle on LUCK anticipates that either the mini Disney vision fully materializes, leading to a significant upside surprise in profitability, or execution challenges with integrating so many diverse assets lead to a dramatic downside miss. Either way, you're betting on large price movement. Got it. Win big or lose big.
Pretty much. And the short on a pure play bowling competitor then hedges against, say, broad discretionary spending weakness, while also betting that Lucky Strike's broader location-based entertainment appeal and operational improvements will allow it to capture market share and outperform its less diversified peers, especially as they leverage their growing season pass data for personalization. It's really a bet on the irreplaceable assets thesis versus the potential commoditization of a single entertainment vertical, like just bowling.
What a deep dive into Lucky Strike Entertainment. From a mixed Q4 performance to an aggressive acquisition strategy and, well, a truly bold long-term vision, this company is clearly in a period of significant transformation.
Indeed. And while the market reacted with, let's say, caution to the EPS miss, management's confidence in their playbook and the potential of their expanded location-based entertainment portfolio suggests an exciting path forward, albeit a very execution-dependent path forward. The next few quarters will be absolutely key in demonstrating how quickly they can integrate these new assets and translate their organic growth initiatives into consistent profitability.
Ultimately, the question for you, our listener, is this. Does Lucky Strike's ambitious mini Disney strategy have the potential to deliver outsized returns? Or will the complexities of integrating such a diverse portfolio prove to be a more significant hurdle than management anticipates? As an investor considering this stock, how would you weigh that incredible upside potential against the immediate operational challenges? It's definitely one to watch. Remember, everything we've discussed today is for informational purposes only and should not be considered financial advice. Thank you for joining us on the deep dive, and we look forward to having you with us next time.